Like most financial innovations that ultimately proved to be successful and useful to society, there were often growing pains, and this was exactly the case with the stock market. During the financial renaissance of the 17th and 18th centuries, many investors were attracted by the fantasy of rapidly multiplying their wealth and often failed to conservatively assess the opportunities and the risks that were presented to them. In particular, having witnessed the wealth brought back via Spanish plunder throughout the entire 16th century, many Europeans began to believe that there were opportunities for other valuable conquests or plundering business opportunities simply beyond the horizon of what they could see for themselves. And they were willing, in many cases, to finance various adventurers who would lead an expedition abroad to find new trade routes or vast wealth for canny investors. Unfortunately, for many people, most of these adventurers failed to create the kind of wealth that they had hoped for. But this didn't stop the speculative spirit, which saw merely that there were those who would succeed and those who would fail. While it was challenging in the early years for investors to be able to discern which investments might actually succeed, many were able to find a shortcut by simply investing along powerful or influential people. For instance, in France, the case of the Mississippi bubble we'll be discussing briefly, the Duc d'Orléans, literally the King of France's brother, was deeply invested in the Mississippi Company. In England, we see a number of royal monopolies having been granted to associates directly of the king. So who wouldn't want to invest alongside what appears to be well-connected people who have an influence over the regulatory structure that dominates their own firms? The challenge really was for investors that information asymmetries were particularly powerful when there was such little financial reporting and so few opportunities to actually supervise the assets that they were the owners of. As a result, they had to simply trust in their managers more than they necessarily should have. The general tendency among investors when they're confronted with a new opportunity is to display what economists call risk aversion, the tendency to be uncomfortable with uncertain outcomes. However, every once in a while, we see a different kind of behavior take hold, greed. What we might call in the 21st century FOMO, or a fear of missing out, often drives people to pursue investments simply because they see other people having profited from a particular choice of allocation and feel that they too need to get on board rather than simply watching their neighbors get rich while they fail to. And this can lead to a shift in people's requirements in terms of new information. They'll simply see new opportunities as being potential upside as opposed to potential downside. And this, of course, clouds their judgment, leading them to sometimes invest in wildly speculative initiatives, which ultimately have no chance whatsoever of ever recouping their investment capital, let alone of providing any kind of economic yield. Now, typically, when there's a stock market bubble of some kind, where prices are wildly out of joint with the underlying economic reality of firms, it usually comes as a result of a confluence of three factors. First, new market opportunities that are generally poorly understood by people. It can be challenging to assess what the meaning of something like the internet might be for investors back in 1995. Unsurprisingly, that created an interesting bubble we'll be discussing soon. But a second factor was loose credit, the ability of people to gain access to margin loans at very low prices. This usually encourages speculators to take on overly large positions on the basis that there will be some kind of greater fool who comes behind and buys at a higher price. And finally, the last sort of bit of kindling that's necessary for a true stock market fire are lies, outright lies by shady people who are bent on trying to lead the market to lean in one particular direction for their own benefit. Now, the first bubble that I want to discuss today is the stock market bubble of 1720. This often overlooked event is well discussed in the Goatsman text, but takes place in both France and England almost simultaneously, and to a lesser extent in the Netherlands. It had a profound effect on the development of the stock market as a technology. It shook the public's faith in the emerging markets for corporate equity and made it almost impossible for firms to raise capital in any of these countries for almost 100 years. Now, ultimately, this bubble, like so many others, was driven by the emergence of new and unproven firms with new and unproven opportunities before them. Some of the bubble resulted, as Goatsman correctly indicates, from wild swings in the regulation to which some of these firms were exposed to. Initially, some firms thought that they would be able to have unlimited charters, allowing them to engage in any kind of profitable enterprise that they could conceive of. That didn't last very long, unfortunately. But a second factor that also clouded people's judgments regarding the fortunes of these firms was the geopolitical competition taking place at the time between France and the United Kingdom, in which people felt that they were doing their civic duty of supporting their country by buying shares in various firms that would enrich the nation through great wealth abroad. Needless to say, these two bubbles developed in parallel, and that's how their story will be told.